One of the major concerns that we're hearing from people right now who are getting ready for retirement is they're concerned about the impact that this presidential election is going to have on their investments and on their retirement planning. And so in order to try to give you more confidence as you're preparing for retirement, I want to show you what has happened in the past with presidential elections, and then also give you a strategy if you're just getting ready to transition to retirement, how you can structure things in a way to put time on your side and just develop a greater sense of confidence. So if you're ready, let's dive in. This first thing I wanted to show you is what the returns have been of the S&P 500 from 1929 through 2023. And you can see over here the average return during US election has been 11.57%, and the average year subsequent to the election has been 10.67%. So there's really not a lot of information here that would indicate that we should really be nervous about the upcoming presidential election, but I've got another slide I want to show you. So you can see this is the annualized returns during US presidential terms from 1928 through 2023. Again, a pretty positive story. I think one of the things to remember is that when you're investing in the stock market, you're investing in businesses that produce goods and services that make our lives better. Now, if you're taking concentrated bets in individual companies, then yeah, there's risk associated with that. But if you're using broad diversification to be broadly diversified across asset classes, sectors, across the entire globe, I think you have less risk. Diversification is one way that you can help reduce the amount of risk that you have in your portfolio. This next chart, of course, just shows that if we go all the way back to 1926 and project this forward, you can see that the markets have rewarded discipline. One of my favorite quotes about discipline says that Jim Rohn said this originally, said, all men will experience pain, the pain of discipline or the pain of regret. The pain of discipline weighs an ounce and the pain of regret weighs a ton. The key is that right now, what a lot of people want is safety. They want a sense of well-being. And unfortunately, what that means is if you try to chase safety in times of volatility, you could end up giving up a lot of potential return. If you're giving up return, it means inflation is going to have a bigger impact on your life. But more importantly, you're setting the stage for playing a game where you're trying to get in and get out of the markets at the right time. The better key to this is to have broad diversification across asset classes, sectors, across the entire globe. Keep your fees low. Use low-cost index funds to create this broad diversification. Now, I just have to throw this one statistic out for you because this one is pretty mind-boggling. But if you go all the way back to January 1st of 1981, just as at the time when Ronald Reagan was getting ready to take office, and you think about all of the things that our country has been through during that time. We've had wars, we've had pandemics, we've had financial crisis, we've had savings and loan crisis. I mean, we have been through a lot as the American people. And one of the things that I always want to emphasize is that the reason that the stock market is resilient is because you and I, the American people, we are resilient. Businesses are resilient. We adapt. We go out and we make things better when we run into tough times. And that's what you should expect to continue going forward, is that there will be challenges. There will be volatility. Volatility is normal. But the key is how you structure your portfolio at a time when you're getting ready to transition into retirement. But if you had $100,000 on January 1st of 1981 and you invested in the S&P 500 index, you didn't touch that money, you just let it compound and grow. By the end of 2023, that $100,000 would have grown to over $9.5 million, $9.5 million by being disciplined and staying invested through the good times and the bad times. So again, discipline is the key, one of the keys to a successful retirement strategy. Okay, now let me show you what to do if you're just getting ready to transition into retirement, because this is a time when risk becomes real risk. When you start taking money out of accounts to help supplement your cash flow needs in retirement, you want to be very strategic about how you do that, and I'll show you how we help people. When you're investing, a core concept that you want to understand is that time is the cure to the volatility of the stock market. The more time you have, the more risk you can afford to take. So it just makes sense as you're getting ready to make this transition into retirement that you're going to want to have some of your money invested in a low risk position. That's the money that you're going to be pulling out for cash in the first couple of years of retirement. And money that you don't need for, say, 10 years down the road, you can be more invested more aggressively. So within the retirement budget calculator, we created the buckets tab. And the buckets tab is a way to help you visualize, based on your expenses, based on your spending, how much money you would want to have in each of the different segments. So you can see you've got your income bucket, In this case, they're going to need $282,000 for the first 3 years of retirement. And then in years 4 through 6, there's $318,000 of portfolio withdrawals that they're going to need. In years 7 through 9, they're going to need $368,000 to supplement their income. And then this a little over $1 million is money that we're not going to have to touch for 10 years. So the idea is that this money you want to be relatively low risk, because this is the money you're going to be living on for the next 3 years. And this is money that you don't have to touch for 10 years, so you can invest more aggressively. Again, time is the cure to the volatility of the stock market. I hope you found this helpful. Thanks so much.